I recently started a new series called 3 or 4 Stocks to Buy Near 52-week Lows. This is me just looking at a basic screener, finding 3 or 4 stocks, trading at 52-week lows, trying to analyze them for you guys. A lot of you asked me about those stocks, and I'm gonna determine here in the video if I believe those are amazing buying opportunities at this price, or maybe they're just value traps and they deserve to be ignored. This is what I'm gonna discuss. The first one is a very popular one. I talked about it a lot of times, but the stock keeps going lower. And I did a trade on the stock I'm going to share with you here at the end of the first segment. And this is SoFi. SoFi is down 39% over the last 5 years. Absolutely insane. The stock used to trade as high as $25, now trading at $6.32. It's been a very bad performance, is all I could say. A lot of you are familiar with SoFi, of course. Maybe you use some of their products, maybe the student loan repayment product, maybe you have a high yield savings account or a broker. And what I really like about SoFi is they have over 8.1 million members. And over the long term, they can cross sell a lot of the products. So they already spent money on marketing, acquiring the customers. Then they can retain them and cross sell them maybe the broker account, or maybe the savings, high yield savings, or maybe an auto loan or a personal loan or a mortgage, or maybe something else in terms of financial products for SoFi. And SoFi has a lot of them. So you have these network effects when they can cross sell a lot of products. And I really like it over here. But for SoFi, this is the main uncertainty is interest rates. A lot of investors on Twitter are bullish on SoFi because whenever interest rates come down, SoFi is going to skyrocket. But other people like me are a little bit skeptical that maybe this is not true. Maybe when interest rates come down, SoFi is going to be earning less interest income. And maybe SoFi is not going to do well as a lot of us believe. If you look at where SoFi is trading at in terms of net interest income, non-net interest, net interest income is 266 million, up 33% year on year. Amazing stuff. Now, non-interest income in terms of origination fees and other kind of fees on volume, they declined 53%. So these things equal each other. So whenever we have lower interest rates, SoFi is going to benefit more from origination fees, but it's going to make less net interest income. So it's going to be very uncertain, and it's not a clear path where if we have lower interest rates, SoFi is going to skyrocket. It's going to depend a lot on the management, on how SoFi, the company, does. But in terms of interest rates, it's not as certain as you believe because they will make less net interest income, but they will make more origination fees, which might equal out. Another thing you have to pay attention with SoFi is a lot of people are pointing out the book value per share. So if you look at the book value per share, it's 551. And SoFi is like 630, so it's approaching book value per share, which a lot of people tend to believe this is liquidation value, below asset value or whatever. And this is a big mistake investors make. Book value per share includes a lot of goodwill and intangible. A lot of stuff you could say brand value. And brand value is variable, it's subjective. You don't really know the exact value of the brand until you go to sell it. So a lot of times you have companies with inflated goodwills. Let's say some trash company, like I remember CoreCivic. CoreCivic is a stock I used to own. They own prisons. They had like $1 billion of goodwill or $800 million of goodwill. And it was massively inflated, but it inflates shareholder equity and book value per share. So what normally you have to look at with banks is tangible book value per share. For example, Citigroup used to trade below tangible book value per share. I think it still does. But I remember it was when Buffett bought it. But for SoFi, it's trading at $3.87 in terms of tangible book, meaning, let's say, shareholders' equity. You take out the intangibles, you take out goodwill, how much you could sell it for, like $3.87. And now sitting at $6.31. But again, I wouldn't try to value SoFi on tangible book because it's not an old school bank with no growth. The company is growing 20-25%. So I wouldn't really try to value it on tangible book value per share. But it's much better than trying to value it on book value per share. But for SoFi, it's just very uncertain. We don't really know what's going to happen. It's an extremely speculative investment. I told people if you like SoFi, put 1-2% of your portfolio if you want to consider it, and maybe dollar cost average down because it's speculative. Like if you're right on SoFi with this chart, SoFi is going to be a $20-$30 stock if you're right. But if you're wrong, SoFi could be a $3 stock. So I wouldn't bet my entire portfolio on a company that was losing money, is just turned profitable, and is going to continue to turn profitable with very optimistic gap estimates of around 83 cents per share by 2028. Now, if SoFi trades at 10 times earnings, which is very low, it's like $8.30, and now SoFi is trading at 632. So the stock is undervalued if they continue the trajectory. They have a good manager, they have a good CEO. He's been doing the right thing. And I like what I'm seeing with SoFi, but I always tell people it's extremely, extremely speculative. Now, what I'm personally doing on SoFi, I'm not in a rush to buy the stock, and I'm seeing an opportunity to benefit from selling put options. So I sold the January 2025 450 puts on SoFi. This is around a 7% return. So I'm getting paid 7% to get to buy SoFi at 450. I collected around 31 cents, but let's say 30 cents. So if you collect 30 cents and you do get assigned at 450, your adjusted cost basis would be around 420. So I'm getting to buy SoFi at $4.20 per share, and tangible book is 387. And this is 27% from here. It has to crash another 27% for me to get assigned. But if I don't get assigned, I collect a 7% return. To me, this is an amazing opportunity here for SoFi. This is what I chose to do. I'm not in rush to buy the stock. If I don't get assigned, it's fine. I mean, I hope you make money with it. And I own HIMS, so I already have volatility in my portfolio and some speculative stuff as well. But for me, yeah, I mean, $4.50 would be an amazing deal on the stock. I'm getting 7%. So this is what I did with SoFi. But I mean, if you're you have high risk tolerance, I mean, I would say SoFi is a buy. And I see improvements. I mean, I'm seeing things getting better. And the sentiment couldn't be worse with the stock. People hate it so much. They're trolling SoFi investors. And I told them, don't do it. Because when stock goes up, you're going to disappear. This is what normally happens. People trolled me when I was buying HIMS at $5 per share, $6 per share last year. That's how it was. And then when the stock goes up, everyone is suddenly bullish on HIMS and is worth 100x and all these things. And the same is going to happen to SoFi, most likely, unless the shorts know something we don't. But I'm not saying what it is. But this is what I have with SoFi, and I'm liking it over here. Okay. The second one is EL, Estee Lauder. This is a stock I did many videos on. Another one I got trolled because I was bearish on it most of last year. And then the stock went up a lot. It went up like 25-30%. Then I got trolled on Twitter. You know, you told us it's not a buy, and then you timed the bottom, and then the stock went up and all these things. Now it's back down. It's sitting at $113 per share. Estee Lauder is an amazing quality company, if you want to call it. It has some very well-known brands like Tommy Hilfiger and many other brands that you're most likely familiar with. I mean, it's a very popular company, has a lot of brands. A lot of you know that stuff. And, you know, it's been struggling, but I'm seeing a lot of improvements with Estee Lauder, and I have to say I'm very, very impressed. You know, GAAP earnings grew 100% from 43 cents to 91 cents. Finally, we're seeing improvements with Estee Lauder. I'm very surprised. I looked at inventories. Inventories are getting back under control. Again, this is something that surprised me, and I like it. I mean, I'm seeing improvements with Estee Lauder. So the question is Estee Lauder an amazing turnaround opportunity at a 5-year low, or is it still a value trap and we should avoid it? This is what I'm going to try to tell you. And for me personally, when I'm looking at Estee Lauder, it's now trading at 30 times earnings. I mean, I just cannot believe it. The stock used to trade at 50 times earnings. I don't know how this was possible. Now it's back to earth at 30 times. The mean over the last 10 years was 33 times. So after this entire crash, Estee Lauder is still trading at 30 times earnings. This is very expensive. I'm just being honest. I know it's a quality company. I know they have good return on capital. I know they have some branding power and people prefer their brands. Although people, and especially consumers, they tend to change preferences, maybe from price point, maybe they want cheaper stuff. Maybe their favorite influencer on social media is maybe pushing up another brand and they don't want to buy certain products. They can change their taste. So it's not as powerful as you believe. This is my thesis on it. And I don't think Estee Lauder is worth 30 times earnings. I'm just being honest with you guys. And I'm just surprised it's still trading at 30 times earnings. The lowest it traded at was 21 times. The company has much worse fundamentals than it did, and it's still trading at 30 times earnings. That, surprised me very, very much. And if you look at net income margins, they're nowhere close to where they used to be. Now it's 5% net income margins. They used to be 12, even 13%. When Estee Lauder used to trade at 25, it was 25 to 27 times earnings. As you could see over here, yes, it used to be around 29, 28, 26 times. Now we're trading at 30 times with much lower net income margins. They expect to get back to 10%. but I'm just not seeing a multiple expansion with Estee Lauder. And maybe the market could get irrational, but I wouldn't personally bet on Estee Lauder going from 30 times back to 50 times. I wouldn't bet on it. So you cannot get a multiple expansion with something like Estee Lauder. What you could get maybe some, earnings per share growth. And earnings per share growth for estimates are extremely optimistic. Again, I'm trying to keep the video short so I can go in as many stocks as possible. But taking the 697 that's estimated for 2028, we take the 697 and we time it by 30 times earnings, assuming no multiple expansion, you get $209 per share. The current price of Estee Lauder is around $113. Let's divide it by $113. You're getting 85% on the upside. And this is using 30 times earnings. I mean, I wouldn't be shocked if Estee Lauder is trading at 25 times earnings. It wouldn't be shocking. And I think you could agree. It wouldn't be shocking if it's trading at 25 times earnings. But even with 30 times earnings and such optimistic earnings per share estimates, you're getting 85%. So for me, Estee Lauder is honestly not a buy. I would like it around $100 per share, $100, $105 per share. It would be close to a double on a very bullish case scenario. But $113, I'm not seeing much margin of safety. And this is just my opinion on it. The third stock that I'm going to talk about is MNST, which is Monster Beverages. This is an amazing company. You could look at this chart. It has actually outperformed Apple over the long term. It's one of the best performing stocks of all time. It's down 16% year to date. It's absolutely crazy. Celsius is also down, but Monster is down 16%. Last quarter wasn't bad at all. They increased revenues 11.8%, net income increased 11.2%, and they repurchased up to $3 billion in terms of a tender offer, which I believe got completed, and they repurchased or I believe it was $4 billion in total. So they're buying back stocks, returning value to shareholder, doing amazing stuff. For Monster, it's trading now at 26 times earnings. One of the lowest it has traded at was 23 times. Now it's trading at 26 times. If you look on a historical average over the last 10 years, this has been a good level to be buying Monster. But I have to say, for me personally, I mean, I'm seeing 10 to 15% earnings per share growth, maybe 15%. But for 26 times earnings, I just can't pay up for Monster. It doesn't mean that Monster is not a buy, but I wouldn't speculate on it staying at 26 times. I mean, I'm finding a lot of companies with similar margins, 15 to 20 times earnings, they're growing 15% earnings per share. So I wouldn't really buy Monster Beverages. But Monster Beverages could be a buy if you're interested. I don't think the stock is going much lower. I'm just being honest. But for me, I just can't pay up for it because I'm finding better opportunities. So to sum it up, I like SoFi over here. If you're a high risk taker, I prefer selling puts. 450 puts, amazing return, 7%, very low risk in my opinion. Estee Lauder to me is not a buy. I don't like it over here. Monster is not bad, but it's not my favorite. I just cannot pay up 26 times earnings for 15%. And this is just my opinion, just my honest opinion on all that stuff. It's not financial advice, but thank you very much for watching. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another update.